Good morning, guys. Don't be alarmed. I just need to test the audio. Test, 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 test. Yeah, we need that louder. Test, test. Woo! Nice. Guys, I see you in a couple of minutes. Sorry, one more thing. I love Frankenfurter's profile picture. Amazing. Hello, guys. Wonderful good morning. Join me. Grab your coffee. Hop in. Hello, hello. Super nice. Nice to see you again, guys. Super. Welcome back officially. I hope you had a great weekend. On our agenda today, as I've already said in our Telegram group, I think it's a cool chapter. It's officially called Valuation of Levered Firms. So you could say valuation of projects conducted by levered firms. I will show you specifically three methods. What I like about the chapter is it's super relevant. It builds on something we have already discussed, net present value analysis. So it's basically a refinement of net present values. It's real life relevant. It allows me plenty of opportunities to criticize the methods. So it's not only awesome, there are plenty of points of criticism that we have to, of course, address. And maybe for students that are a little bit more insecure in finance, it is a chapter that you can study almost standalone, meaning in the worst case, you're struggling with all kinds of chapters. This is a chapter you could theoretically look at completely in isolation and it would still make sense. Obviously, I always have an interest that you see it in context, that you are able to connect it to other topics. I'm just saying it is possible that you look at it in relative independence. So as far as I'm concerned, there's no reason why not every single student should score the maximum number of points if something from this chapter is on the exam. Okay, so you can practice this to perfection so that when the exam starts, you already know whatever from this chapter will be on the exam, you will ace it. Before we hop in, guys, are there any questions? Is there anything I need to know about? Finance related or also not finance related? Anything, any questions, any problems, any issues, any worries? All right, I hope that's really true. If nobody has worries, then it's of course amazing. Okay, let's hop in. Let's hop in then. Like I said, chapter is called Valuation of Levered Firms. Let's start first with a sort of broader look at things. So how do you approach firm valuation? There are, broadly speaking, two different sort of intellectual approaches how you could do it. You can determine the value of a firm in isolation, and you can determine the value of a firm relative to something else. So give you a brief example, non-finance example. If you come to my office and you say, hey Flo, do you think I'm a good finance student or a bad finance student? I would say, well, tell me your grade. And what I could do is, I could basically look at your grade, let's say you say 6.5. I could look at your grade and determine, based on your personal study progress, on your personal study trajectory, if you have improved, if your grade has deteriorated. So I basically try to analyze your performance in finance in a standalone kind of way. What I could also do, I could try to put your grade in relation to the grades of other students, so of your peers essentially, of students that are enrolled in the same course. So I could say, well, you have a 6.5, the average grade in class is, let's say, a 6, so you're actually better than, you have performed better than. So broadly speaking, two categories of valuation are available. We could do a firm valuation by comparing our firm, the firm we're analyzing, to competitors, or in isolation. Let's talk very briefly about comparing a firm to competitors. There are different methods here. You could approach it via the book to market value. You could approach it via the price earnings ratio. Both, by the way, are metrics that in the first year finance course you have looked at in the context of financial statement analysis. So you could easily freshen up your knowledge here. Why would we use those relative valuations? So figuring out the value of a firm by comparing to other firms. The underlying reasoning here is, when we use relative valuation, we make a big assumption. We assume that markets make mistakes on individual cases. So that means overall the market, when the market, investors basically analyze firms, they sometimes screw up basically. They get individual valuations wrong, but on average, they will be correct in evaluating a whole industry. So essentially, how can we justify the use of, let's say, multiple methods, so relative firm valuations, by assuming the market gets it right and only screws up basically in exceptions. This, however, is not what we're going to discuss in great detail. This is basically it. We will zoom in into 3 firm valuations, methods, how we can evaluate firms in isolation. In case you're wondering why are we focused on this and not do everything, is this more important than the other one? I have to say, in the real world, both are very important. All of them are used. Don't forget that firm valuation is not an accurate science. We do the best we can, but we have to make plenty of assumptions. So in the real world, if I have more than one tool available, I will use them all so that I get a bit of an indication, what do all my results indicate? So simply it's a kind of triangulation, I would say. And in case you're wondering, why are we not doing this in detail as well then? The reason is, unfortunately, we're constrained. So I would of course love to show you, but it's an introductory finance course, an introductory corporate finance course, so we have to make hard choices. If you say, well, you want to know more about this, then I have good news for you. If that's really something you're crazy interested in, you might want to look at the curriculum of the Master of Science, Finance and Investments, where in your first block, so the moment the course starts, you will have a whole course called Valuation, where all of this will come back. And I know from experience, my former second year bachelor students that go on into our own finance master absolutely crush it there, okay? One more thing I want to say, or want to show you before we dive in, which I think will add value. The whole chapter is not complicated, so I've color-coded the slides as best as I could. If you read the chapter in the book, I think you will not really struggle much. So I was thinking, how can I add value to this? I don't want to read something to you that you can read by yourself. And I thought, I think the one thing, maybe not the one thing, but one of the things where I can add value is to put this into perspective. Because these methods, as you can see just by their names, WACC method, flow to equity method, adjusted present value method, I mean, just the names indicate already that we will be splitting hairs and really looking at details. So I thought, what could add value to basically your study experience is that I put it into perspective and show you what exactly, where on the map of things is this really happening. So let me quickly show you. Oops. All right. You remember, of course, hopefully, our net present value calculations. Let me write it down quickly and explain in a second what's going on. Net present value equals. So we use this for evaluating should we do a specific project or not. We even said it can be used for firm valuation. You could say I calculate the net present value of a whole company. Let me write down the abstract formula, minus cash flow at T0 plus cash flow at T1 divided by 1 plus discount rate to the power of 1 plus cash flow T0, 1 plus discount rate to the power of 2 plus ... plus cash flow at n divided by 1 plus discount rate to the power of n. So this is what we have discussed. The net present value of a project, or theoretically of a whole firm, equals minus cash flow at T0. Don't drop the initial minus. When you want to engage in a new project, typically you start with a cash outflow because you have to set up the project. Think of my example. Albert Heijn wants to open a new supermarket in Vienna. I mean, not now because lockdown, but theoretically. Then they have to first purchase the shop, the furniture, the equipment. So typically the first cash flow is negative. Does not have to be like this, but it's most common. What else happens then? Well, in the year afterwards, that's in 1 year from now, we will start operating our whatever new project, let's say the supermarket, and we will earn a certain cash flow at T1. This is of course a future value that we will be earning in 1 year. So we cannot simply add this up, we need to discount it. So I discount by dividing by 1 plus discount rate to the power of the time. This is 1 year later, so to the power of 1 plus the cash flow that we will be earning in year 2, discounted by 2 years. And you keep doing this until you end up with cash flow in year n. So that represents basically the last year of the project, divided by 1 plus discount rate to the power of time. So that is then in year n, whatever that is, 20, 25, whatever. So this should not be all that new. So how do the 3 valuation methods that we will look into today connect to this? Well, so far we have been, not only you, but also me, we have been rather general and rather casual in our, basically how we talked about it. So there are several things, to be more specific, that I want to point out here. So what is it exactly that I mean when I say cash flow? What exactly is that? Well, we said theoretically it could be anything. I could forecast the revenues, I could try to forecast gross profits, I could forecast operating income, so EBIT, I could try to forecast net income, but really cash flow simply means some sort of stream of cash that ends up in my pocket. So That's number one. And number two, the discount rate. So I remember in sort of random conversations that we had where discounting played a role, some of you then, I don't want to say interrupted, but asked, yeah, but what about the inflation rate? Stuff, so basically detailed information that would make our calculation more lifelike. So why are we looking now into these three methods in more detail, or what do these methods have in common? They are all what we call DCF methods, DCF, that's short for discounted, well, because of this, we're discounting, we're operating with present values, cash flow. So they are all methods where we take some cash flow and discount them in some sort of way. Let me be a bit more specific, even more specific. What are these three methods gonna be about? They are all the same. They all involve the same steps. They all involve that we say we are trying to set up at the end of the day a net present value calculation. Where do they differ? We will zoom in now into which cash flows should we actually use and how should we, if and how should we adjust the discount rate. Okay, so all methods will boil down to a calculation roughly of this form. The differences that you will observe are the following, two of them: adjusting the cash flow or adjusting the discount rate. That are the differences. So I don't want that you get lost in the details of these methods. At the end of the day, the core intellectual fundament is always the same. We try to figure out, should we do a project, yes or no? We set up a net present value calculation. All that will happen in all of the three methods. The difference is gonna be which cash flows will we use and how are we gonna discount them, okay? Just for your mental map. Okay, let me open my slides again. So there we go. All right. So like I said, this is not something that we're gonna discuss. The relative valuations, we will zoom in on trying to evaluate a firm or a project in isolation. We will look at the WACC method. You will see this is exactly what we have done so far. Very little new here. Flow to equity and adjusted present value. Why would we use these methods? Why not only do relative valuation? Well, the assumptions underlying firm valuation in isolation are different. So when we use, for example, the WACC method, we assume that markets make mistakes sometimes. So we say we are not going to rely on the overall judgment of the market, of a whole industry, as in relative firm valuation. We say markets make mistakes and therefore I rather do the valuation work myself. That is basically the core logic. In the real world, like I said, I would use both because we have more than one method, so there is no reason to not use them all. And then you get probably different outcomes that if they all point in the same direction, you get a bit of an indication. All right, so like I said, the three methods that are on our agenda are WACC method, the name already gives it away what this is about, figuring out certain cash flows, and we will discount using the weighted average cost of capital. We will use the flow to equity method and the adjusted present value method. There's already, it's a bit of a teaser trailer almost. When you evaluate an investment opportunity, so classic net present value calculation application, you have to not only account for the direct cash flows, cash outflows for setting the project up, or cash inflows from basically running your shop then, engaging in the project, but there could be all kinds of financing benefits or costs associated with the investment. Remember that so far we have often pretended that you can adjust your capital structure like this, equity up, equity down, increase the leverage, decrease the leverage, as if there were no costs associated with it. In the real world, that's of course not the case at all. Just obtaining a loan is costly. The bank wants a little bit of a cut of the whole deal. So it makes sense to consider financing benefits and financing costs. I have a brief question for you. Don't be shy, just unmute yourself. What do I mean with financing benefits? What's that about? Any idea? Don't be shy.
Maybe in terms of taxes.
Yeah, Alice, give me a little bit more. I think you are on the right track, but I need a bit more than this. What do you mean with maybe taxes?
Maybe, I don't know, getting a loan can be less expensive in terms of taxes than another thing. I don't know.
Why would a loan help me pay less taxes? It's a question for everybody.
Interest is deductible.
Yes, you're both right. You're absolutely right. It's of course, again, we're coming back to the infamous tax shield, right? If you finance a project using debt, you will get to enjoy the benefit of the tax shield of debt, meaning the more interest expenses you include in the income statement, the lower your profit before tax will be, and the lower your eventual corporate tax payment will be. So that is exactly what is meant here. Absolutely correct. And maybe also just for your motivation. So this chapter is really very real life oriented. And I want that you see when we talk about financing benefits, we really go all the way back to Modigliani Miller, really. The tax shield is something that Modigliani Miller have basically originally explained to us. So again, one more indication that even though Modigliani Miller seems like abstract brain jerk off, it really is relevant in the real world, okay? There is more to it. So the cash flows are not always as straightforward as sometimes it might look in our classes. Yeah, just forecast and discount and boom, there you go. You sometimes, of course, get to enjoy financing benefits, sometimes, of course, financing costs, but there is more. What else could there be? So it's very common in the real world, and you can really, right after class, check that in newspapers. Sometimes companies receive tax subsidies. So in America, that's extremely common. A large company in a press conference says, we are slowly thinking of moving our headquarters to a different state. Then all the different states will start competing. If you move your big headquarters to our state, then you will not have to pay corporate taxes for X years. So why do states do this? Well, they are of course run by politicians, governors. If I am the governor who gets to move Google or Tesla to our states, I can in my re-election campaign say, I'm the guy who created whatever, 500 new jobs here. So that's why governments of states or even countries are willing to sometimes give up taxes. It's a game of re-election. By the way, I don't know if you know John Oliver and I don't know if you like him, but he has about exactly this, a great episode on Last Week Tonight. Check it out, it's on YouTube of course. Have a look at it. It's quite interesting of course and super funny. There could be government guarantees. Why is a government guarantee relevant? Well, if a government guarantees for my creditworthiness, I will get probably a lower interest rate on the debt I raise. So that could also be very beneficial for me. All right. The two most important methods that include these just mentioned financing side effects are adjusted discount rate. That would happen through the WACC, or a different method, the adjusted present value method, the APV method, which we will do anyway. Okay, what is the problem with the WACC in this context? Well, the WACC as well as the flow to equity method assume constant debt to equity ratios. Maybe let me go back to my quick sketch here. What does this mean? Well, we've discussed before that the correct discount rate a firm should use is the WACC, right? The weighted average cost of capital. So in simple human language, that's basically the interest rate that a firm pays over its whole right side of the balance sheet. So debt and equity together. Obviously the company wants that this is as low as possible. Naturally, it's like you buying a house, you want the interest rate that you pay on your loan to be as low as possible. One of the things that I think you can see here rather nicely is an assumption that is baked into the formula. You see I write here R, R, R. Here we are in year N. I mean, for all we know, that could be year 25. We don't know. That could be very, very far in the future. So what is the assumption that is baked in here? That we always use the same discount rate. I even use the same variable, R, or WACC, whatever. But it's always the same variable. So what does this mean? We're assuming that the WACC will not change over, extreme example, 25 years. Is that realistic? Yes and no. So first of all, it is possible there are firms that say we are aiming for a very stable debt to equity ratio. So the proportion of debt to equity is not fluctuating wildly, but they are aiming for a relative constant mix. Then yeah, this is actually not unreasonable to assume, because if your proportion debt to equity, so that debt equity ratio remains constant, then your WACC will not change. And then yes, the discount rate will also not change over 25 years. However, that is not a given. Companies sometimes, of course, change their leverage, increase it or decrease it. The moment you change your leverage, you already know this, of course, from Modigliani Miller, then the WACC will change. So you cannot then simply over 25 years use the same discount rate, because the WACC is our discount rate. So let me go back to the slides. Okay, so what is the problem then? Well, we are assuming that the WACC remains constant, which is only correct if the debt to equity ratio remains constant. And furthermore, we also assume that the tax rate remains constant and unchanged over the life of the firm or the project. Neither of these assumptions necessarily holds in the real world. That's really something you would have to check. Okay? Last but not least, the adjusted present value method is considered to be much more flexible. So in cases where the level of debt is known and it fluctuates over time, this is a method that would be preferable. I have to say, when I look at the book, I don't fully agree. I will show you in a second where my grief comes from. Okay, have a look at this. This is method 1, WACC method. There's nothing new here for you. It's a nice recap, and maybe it looks slightly different than what you've seen so far. I'll translate it, so no worries, please. Okay, so imagine now that over the life of a specific project, or if you apply this method to figure out the value of a whole firm, the debt equity ratio changes. As I've discussed already, then the WACC will change as a consequence of this, right? Okay, what does this mean then? If you were to use the same unchanged WACC, you would make a conceptual mistake, a big conceptual mistake. And changing the discount rate only slightly, but applying it then over a period of 25 years, that means that every year the mistake that you made will accumulate and the final result will be grossly wrong. Okay? So what would you have to do if you are hell-bent on using this method, even though you do know that the debt to equity ratio changes? How to deal with this? It's not complicated. How you would deal with it is you just recalculate the WACC for each year, theoretically. And this is what I meant with maybe that looks now a little bit different to you, but it really isn't. What that is it's the formula of the WACC that you have seen a million of times, only presented slightly differently. So let me explain. So this here is our WACC, so that's basically WACC, but for T1. So we say, first we don't calculate a WACC, we calculate the WACC for the first year. Again, why are we doing this? Because we're now trying to figure out, can we use this method in an environment for a firm where the debt to equity ratio changes and the WACC as a consequence changes. So I recalculate it for every year. WACC for year 1. Here you see the order is just a little bit sort of, I don't want to say the wrong way around, it doesn't matter. It's different than what you have seen so far. So let's start with the weights. Wait, let me get my note layer on. All right, let me quickly translate just so you're not confused or worried. What is this here? This and this are, of course, our weights. So that tells us in percentage how much equity and how much debt we have. So D is, of course, short for debt. E is short for equity. What does this addition here mean, T1? It simply means the amount of debt that we have in the first year, the amount of equity that we have in the first year. Why do we do this? Because we're trying to figure out how to use this method, even if the firm readjusts its capital structure, so changes the proportion of debt to equity. Divided by TV, what's that about? please don't be confused. I think Celine already showed you a slide where that was described as well. This here simply is short for total value, and total value is debt plus equity. Normally when I write this formula down for you, I always write debt to equity. The book sometimes, and even my own slides, sometimes simply contract it and write TV for total value. It's exactly the same thing, okay? So we have the weight of debt, how much debt do we have in our capital structure expressed as a percentage, multiplied with the cost of debt, RD, again, in the first year, because it could change, of course. Plus, we have the weight of equity, how much equity do we have in the first year, divided by, again, TV is short for debt plus equity. So that are our two weights, the weight of debt, the weight of equity. Here we have the cost of equity for the first year. How do I get my cost of equity? Where is it coming from? Tell me, guys. Yeah, excellent, Enrique. Absolutely correct. This is where we will utilize our good old friend, well, maybe not good friend, but old friend CAPM. That's where that is coming from. And just please note, the only difference compared to the formula that you have seen a million times is that I'm a bit more accurate and say for every parameter year one. And this here is, of course, 1 minus TC. That reflects our after-tax cost of debt. So this is the normal WACC formula. The only difference is that we say we calculate it specifically for year one. Now, and then after year one, we recalculate it. What could have changed? Well, everything theoretically could have changed. The cost of debt could have changed, the amount of debt could have changed, the cost of equity could have changed, and last but not least, the amount of equity that the company uses could have changed. All right, let me get rid of this. Save. All right, so what is the reasoning behind this? How can I say if your amount of debt or the proportion of debt to equity changes, we need to do this kind of complicated workaround to be able to process our data? How can I say this? Well, if of course the proportions change, then the risk to equity changes. So if equity holders, shareholders are exposed to a higher risk, they want to be compensated with a higher return. So it could be then that the cost of equity will go up as well. Okay? All right.
I have a question.
Shoot.
Shouldn't the total value also change since the equity and debt are changing?
Yeah, you're absolutely right. I don't know that I would say should it change, but I certainly am willing to say it could change, of course. Because if I say this is here debt plus equity, it very likely will change. Theoretically, it could, even though you adjust the amount of debt and the amount of equity, it could remain constant. Imagine you say I increase debt by 100 and at the same time I decrease, oh sorry, wrong camera, sorry. If the amount of debt increases by 100, at the same time the amount of equity decreases by 100, it could remain constant. Yeah? But you're absolutely right. Theoretically, everything could change, even the corporate tax rate, of course. Yeah? So the point I'm trying to make here is you would end up recalculating the WACC for every single year. So you're basically intellectually calculating a new discount rate for every year, and each calculation would incorporate the best estimates that you have. Yeah? Okay. Yeah, so when is this method then appropriate? Or when is it, I don't want to say appropriate, when is it basically most useful, the easiest to apply? It's super handy if you analyze a snapshot in time, so a single period. Because then you just calculate the WACC once and you're good to go. If you analyze multiple time periods, the debt to equity ratio would have to be constant, unchanged, so that the WACC remains constant, unchanged. Otherwise, you would have to do all these sort of side calculations and constantly recalculate WACC. Now, it is not impossible, of course. You could still do it. It's just a bit more effortful. I don't fully agree with this sort of criticism because, I mean, you do this in Excel anyway, on the exam and in the real world. So yeah, well, it's a bit more work for your Excel sheet, but should not be that complicated either. It's perfect for firms that are in a steady state. Why would a steady state simply means there's not a lot of adjusting of the capital structure going on. Now, why would we observe a firm being in a steady state? There are two reasons for this. It could be on purpose. So that would be firms, as I've initially mentioned, that simply attempt to have a constant leverage ratio so that the proportion debt to equity is as stable as they can manage, basically. Or the steady state could be a result of basically, well, not really a voluntary decision by the firm. It is involuntary. Why would that be? When issuing debt or equity is costly. If you are hardcore interested in finance, and if you already say, for me it's virtually certain I will do a finance master later on. If you are interested, then have a look. Let me write it down. So this term here, when first of all, issuing debt and equity is always costly. So I would specifically point out another situation. It is called rationing. Rationing in the capital markets, rationing in the debt market or rationing in the equity market. Rationing simply means that even though your firm wants to raise debt, the debt market is simply not interested in you. So if you want, I can send you my first paper on convertible bonds, where I really show for specific historic companies, the company needed cash desperately. I mean, they were really crashing hard. You know, pecking order, first step is use your internal funds. These companies had no internal funds. Step 2 in the pecking order is try to raise debt. And I can really show that the companies tried that. So they said, okay, fine, let's issue a bond. But nobody would buy it. So after a couple of days, they really had then an announcement in the newspaper, we withdraw our bond offer. Then the company tried to issue equity. But the IPO was also not successful for the same reason. Nobody wanted to buy their equity, their shares. So the company withdrew this as well. And the paper that I wrote is about convertible bonds. So last resort was then issuing convertibles. But the whole situation would be described as rationing. We would talk about it in the following way. A firm is rationed out of the debt market or is rationed out of the equity market. It's a big research topic. Like I said, has nothing really to do with our exam now, second year bachelor. If you're very interested, you might want to look into this. If you are, after looking into this, are even more interested, I happily send you my first paper. I'm very proud of it. It's very interesting to read. It's almost like a crime story a bit. You just need to post a comment on YouTube and I send you the paper, no problem. All right? Okay, now yeah, let's do some math stuff. How does the WACC method work mathematically? You see, this should not immediately freak you out. I will translate, of course. The net present value of the project equals minus initial investment. Don't drop the initial minus. Like I said, this is very common because you have to get the new project somehow started, and it typically involves spending money on setting up whatever, the new shop or buying the new factory or something like that. Plus, I know this looks super mathematical, but you have seen this before. What this term here really means is the sum sign, the Greek sigma, simply means we have now a series of terms, UCF, so unlevered cash flow, divided by 1 plus WACC to the power of time. So this is mathematically simply a shorter way of writing down, well, what I wrote down on the whiteboard. UCF year 1 divided by 1 plus WACC to the power of 1 plus UCF for year 2 divided by 1 plus WACC to the power of 2. And you do this from year 1 until year T. Okay, so this is simply a shorter way of, basically I save the effort of writing down all the terms. The meaning is the same. And then of course we have to immediately say, wait a second, what is UCF? What's an unlevered cash flow supposed to be? So this is how you have to read it. The UCF has to be replaced with this calculation. EBIT, so earnings before interests and taxes, multiplied with 1 minus the corporate tax rate. So this will give us the unlevered cash flow. There's sometimes students ask about this, not only students, just people that are relatively new to finance. How is then the tax advantage incorporated here? So I actually added this additional information. It is not included in the UCF. It is not included in the numerator at all. So where is the tax advantage then? the tax advantage of that is actually included in the denominator in the WACC itself, right? I mean, that's, let me go back, that's where we have this, right? Cost of debt multiplied with 1 minus tax rate. So this whole term here, gives us the after-tax cost of debt. RD alone, this here is the pre-tax cost of debt, and the whole term is the after-tax cost of debt. Okay? So in case you're wondering, do we not in the WACC method consider the tax advantage? Yes, we do. Just not in the numerator, but in the denominator, and to be more specific, in the WACC. And to be even more specific, we include it by adjusting the cost of debt. RD is simply the pre-tax cost of debt. If I multiply with 1 minus TC, the whole term gives me then the after-tax cost of debt. That's all. Of course.
So the sign like for the summing is for the entire thing, right? Not only the lower parts of the thing. Like it's for.
I know what you mean. Yeah, Storm, you're right. Let me go to the thing. Yeah, it is. It's basically for the whole term, so it really represents. Let me show you. It really go away. Go also away. Also, oh, yeah, it really represents all of these terms here. UCF, UCF, UCF. The only thing we have sort of separated that we showed before is the initial investment, the negative cash flow. And then here, this is what the sum sign would capture. The discounted cash, the unlevered cash flow for all the years that I'm interested in, divided by 1 plus WACC. Yeah.
Yeah, thank you.
You're most welcome, of course. So, let me open this. Bloop. There we go. And of course, I mean, we need to do an example. I mean, this is all beautiful, but let's do an example. So it is possible that the example might be a little bit too fast. I mean, I do my best to explain it. As you can see, I've gone, completely crazy with color coding. If you struggle with it, I cannot stress this enough. This is the first time you see this, and we go through it, well, at university speed, not too slow, not too fast. But this is sophisticated stuff. So be also a bit patient with yourself. Don't immediately despair. You do this for the first time. So it is possible that after the lecture, then rewatch the clip again, rewatch the explanation again a couple of times. With your finger, try to trace every single number. Where is everything coming from, okay? So don't give up too quickly. Especially important, don't be too hard on yourself. I told you that's the reason why I uploaded my research paper presentation. New finance content is challenging not only for you, that's just challenging for everybody. And everybody needs to be a bit patient and work on this, including myself, okay? So don't give up too quickly. You can and should on the exam ace this. Let's look at it. We are looking at a company that has bonds outstanding. So we already know it's not an all-equity firm. Remember, a bond is simply a very, very large loan that is broken down into many small pieces that can be traded individually. Okay. The market value of the outstanding bonds is $30 million. The company has a yield to maturity of 8%. The concept yield to maturity is first year content. In a nutshell, just for the time being, it is what we will use as our cost of debt. There's nothing to be too confused about. The company also has 5 million ordinary shares outstanding. Again, also for the exam, I would make it a habit to have different pens or highlighters because I tend to confuse numbers. 5 million stocks or shares, I can easily confuse with 5 million euro. So I always in the past when I did exams myself and even when I do color coding, I need to remind myself what are monetary values and what are not monetary values. So that is not $5 million, that is really number of shares, 5 million. Each of the shares outstanding is currently being traded for $20. We know the beta of the stock of this firm, it's 1.20. Is it more risky than the market, as risky as the market, or less risky than the market? Excellent. Yeah, very nice. The beta is more than 1. That means it's more risky than the market because the market itself has a beta of 1. So it's more risky than. The company thinks that its current debt to equity mix is optimal. That is an indication for us that we are talking about a stable debt to equity ratio. Nice. Okay. The company is considering a new investment opportunity that would cost $40 million. So that would be some sort of startup costs, initial investment. The investment is expected to generate pre-tax cash flows, so EBIT. How can I say pre-tax cash flows are the EBIT? EBIT means earnings before interest and taxes, so before taxes. So clearly it's pre-tax. We have not paid the taxes yet. The firm expects to generate pre-tax cash flows of $18 million for 5 years. Is this a perpetuity? Excellent. I see you all shaking your head. You're absolutely right. A perpetuity means the same cash flow every year forever. This is for 5 years. 5 years is not forever. So it's not a perpetuity, it's a 5-year annuity. The first cash flow will occur in 1 year. The investment does not change the risk of the firm. That's relevant. Think of my example. A company wants to figure out should they do a project or not, but it's a baby food company that considers an assault rifle project. Okay, so that would not work. We are specifically interested now in a project that is in line with what the company normally does in the course of its ordinary operating activity. So it's a reasonable thing to say the project has the same risk as the overall firm. Okay, what else do we have? The corporate tax rate is a hefty 28%. The interest rate on treasury bills is 6%. The expected market risk premium is 7.5%. I have a question. This could reasonably be an exam calculation, to be honest. I'm wondering, what do you do with this information on treasury bills here? Why am I saying this? Is this relevant for us?
Would that be the risk-free rate?
Yeah, excellent. You're absolutely right. The interest rate on short-term T-bills is the next best thing that we have available in the real world as a risk-free rate. So that is why this is mentioned. And I have a second question for you. What is exactly the market risk premium? What's that?
Sorry, the difference between the risk of the market and the risk-free rate?
Excellent. Yes, you're absolutely right, Storm. It's the bracketed term in the CAPM, RM minus RF. It tells us only the risk compensation for exposing yourself to the market risk. Yeah, excellent. Very, very good, guys. Super. And our challenge, our task, our privilege, using the WACC approach, we will try to determine if the company should do the project or not. So it's just a very elaborate net present value calculation. Let's do it.
Can I ask a question?
Yeah, of course.
Why is the interest rate on the treasury bills the risk-free rate again?
It is not the risk-free rate, it is what we use to basically approximate the risk-free rate. Don't forget, this is now not Modigliani-Miller world, this is really a lifelike example. Yet in the real world, we have to deal now with beautiful financial formulas that all call for a variable called risk-free interest rate. The risk-free interest rate, theoretically, conceptually, is the interest rate, the return that you earn on an investment with no risk at all. So really a zero risk. But then if you think about it, the formula is beautiful. But then in the real world, what would you use? Which investment in the real world is really risk-free? You could say, if you invest in bonds of Switzerland, Austria, the Netherlands, Germany, you could say, well, isn't that risk-free? How often have these countries gone bankrupt? It seems maybe unlikely, but countries, of course, do go bankrupt. Let's not forget, we are having now every evening riots with people setting police cars on fire. So I think it would be unreasonable to say an investment in the Netherlands is risk-free. If you say, naja, then fine, then let's invest in Austria, that must be risk-free. Austria today went into full lockdown. I don't know how risk-free an investment in Austria is right now. So coming to a final answer, there is not a single investment in the real world that you can imagine that really has a zero risk. So what do we do then? We need RF to do our beautiful math. So what we do then is the next best thing. We try to find an investment that does not have a high risk. We say we are looking for a risk-free investment. It doesn't exist. So then let's take the next best thing, an investment with a very, very, very low risk. And the current, I would say, standard is using the interest rate on American short-term treasury bills. So American bonds with a very short maturity, typically a month. Okay? That's the idea. But I don't want that you think that these are risk-free. They are not. They are just considered to have a very low risk. Make sense?
Yeah.
Super.
Thank you.
You're most welcome, of course. Okay, so we want to do our net present value calculation, but you know we cannot immediately do this because you know we need the WACC for discounting, which we don't yet have. So step one will be, we'll try to figure out the discount rate, the WACC. The formula that you see here is not very new. Equity divided by total value. Don't forget, this is simply a slightly different way of writing debt plus equity. So equity divided by debt plus equity multiplied with the cost of the levered cost of equity plus debt divided by debt plus equity multiplied RD is the pre-tax cost of debt. If I then multiply it with 1 minus TC, I get the after-tax cost of debt. So this is, I would say, the normal WACC formula. But of course, we need to figure out now which values should I fill in. We know, let me go back one slide, we know quite a bit about the firm. We know how their debt financing looks like. We have some information on their equity financing. So first, in step one, we have to figure out E and D. So the amounts of debt and equity. In the real world, that is not very complicated. You can look it up, of course, on the balance sheet. We have to be a bit more elaborate. So we start with calculating equity. So I'm trying to figure out E here so that I can calculate the weight of equity. How much equity in my capital structure do we have? We know the company has 5 million shares outstanding. That was given. Whoop, here. See the color coding? That's how it works. Shares outstanding. It's the same ugly yellow as before. Multiplied with $20. What's that? That is, of course, the current price per share, the market price per share. And that gives me $100 million. So I already know how much equity does the firm have. $100 million. That's where it will go. Step two, figuring out the market value of debt. Is this gonna be complicated? Well, the company has bonds outstanding with a total market value of 30 million. Where is it? Market value of debt, 30 million. Boom, done. It was directly given to us, no problem here. What am I doing in the next step? I calculate now the actual weights. So really equity divided by debt plus equity and debt divided by debt plus equity. That's what I'm doing here. Equity divided by total value. Again, total value simply is debt plus equity. We have figured out that the company has 100 million equity. Whoop. And we divide by market value of debt and equity. Market value of equity is 100 million. Sorry. The market value of debt is 30 million. So that's how I get the 130 million here. Press the buttons. This is our result. What does it mean in a full sentence? It means equity makes up for 76.9, almost 77% of capital in the capital structure. And I do something very similar, of course, for debt. How much debt does the company have? It was specifically given that the market value of the outstanding bonds is $30 million. I divide by total value, so that's debt plus equity. It's of course the same 130 million that I used here. And that gives me 23.08%. Just brief question in between. Is this a firm, would you say, based on the numbers, based on the weights you have seen, is the company very highly levered, would you say? Excellent. Excellent, guys. You're absolutely right. I'm just sometimes asking in between because I don't want that you look at these numbers as simply some abstract whatever something. Always try to put this into perspective. What does this actually mean? Is this good or bad? Is it high or low? So immediately try to, articulate it in a sentence really. All right. So we have now, what have we calculated? Well, we have now calculated successfully our weights here. So we have this, this is equity, and this here is our debt, okay? What else do we have? Well, we have information on the beta of equity. It was given as 1.2. You said correctly it's more risky than the market. Correct, of course. So we can indeed launch into the CAPM and calculate the levered cost of equity. Don't forget, should not confuse you too much. When we as a firm use the CAPM, we would say we calculate a cost of equity. When a shareholder uses the CAPM with exactly the same data, he or she or they would say, I'm calculating my required return now, okay? So that's the same thing. It just depends on who is using it. Now and we fill in our information. RF is 6%. That's why I said, what do we care about the treasury bill interest rate? That's what we need. We need to remember that the treasury bills, the interest rate on short-term treasury bills is what we use as a next best thing to approximate the risk-free rate. Plus beta, the beta of the levered equity, 1.20, multiplied with, and this is where Storm before correctly explained, the market risk premium is already the whole bracketed term. So this was given to us in one go. We did not get information. The return on the market portfolio is something where we then still have to deduct the risk-free rate. The market risk premium is already RM minus RF. So the work was already done for us, okay? That is why I can immediately fill in 7.50 here given to us. Press the button and you will find the cost of levered equity is 15%. So we have now successfully calculated this as well. What else do we need for our WACC? Well, we have everything together. We know the yield to maturity, which is what we are gonna use for RD. It already is a pre-tax cost of debt. Perfect. So we have our ingredients in place. Let me close this quickly. All right. So this is our final formula. We are trying to figure out a WACC. We have calculated our weight of equity. Using the CAPM, we have calculated the levered cost of equity, 15%. We have calculated our weight of debt, 23%. Given to us was already the pre-tax cost of debt in the form of the yield to maturity, 8%. The only thing missing is we need to convert it into an after-tax cost of debt simply by multiplying with 1 minus corporate tax rate, which was given to us, 28%. Boom, there it is. And I type this in and my result is 12.87%. So what does this mean? The WACC, the weighted average cost of capital of this firm, is 12.87%. And based on the fact that the project we are analyzing, where we try to determine should we do it or not, the cash flows should be discounted with the WACC. Okay, let's hop into the actual sort of WACC valuation method. As I've said, all methods are some sort of net present values. So net present value equals minus the initial investment, so that's simply the startup costs. Don't drop the initial minus. Plus unlevered cash flow divided by 1 plus discount rate to the power of time. But we need, of course, to figure out what exactly is the unlevered cash flow. What was given to us, let me go to the explanation. It was explained in the whole example that the investment, so the project we're analyzing, number one, in order to get it started, we have to pay $40 million. Once we have paid this, once we have gotten it started, it will earn cash flows for us. How many? Not how many. At what magnitude? $18 million for 5 years, but pre-tax, right? Pre-tax cash flows. That's given to us in the form of an EBIT, earnings before interest and taxes. So we have to pay 40 million and then for 5 years we will earn 18 million. Perfect, let's do this. So I first calculate the unlevered cash flows. It's very easy. The formula we are using is simply EBIT multiplied with 1 minus TC. So that tells us then how much money is left after we have paid our corporate taxes. Or you could say, what are we calculating here? We are calculating basically our, I would say, after-tax earnings. So 18 million, that's the unlevered cash flow, multiplied with 1 minus 28% corporate tax rate. And that gives us $12.96 million. And now we're really done. We just fill in the final values. Net present value of the project equals minus 40 million, that's the startup costs. Please observe, I did not, even though I'm very vulnerable to this too, I did not drop the initial minus, plus unlevered cash flow multiplied. What I have done here, I know this looks super weird to you now. I just wanted to show you a slightly different way to calculate a series of 5 cash flows. If you say, I don't want to deal with this at all, you could also simply say 12.96 million divided by 1 plus WACC to the power of 1 plus 12.96 million divided by 1 plus WACC to the power of 2. So this is just simply an alternative way to do it. Don't need to bother with it on the exam. You will of course be allowed to use an Excel sheet, so you can do it any way you like. And ideally you have a formula perfectly set up for net present value. So solve it in whichever way you want. I want that you're not confused by this term. It is simply the series of cash flows discounted back to T0, converting them into present values. And we find the result, the net present value of the project is 5 point something million. Should the company do this project, yes or no? Yeah, I see a lot of either head banging or correct answers. Yes, you're absolutely right. It's a very highly positive net present value. I mean, almost 6 million. It's a lot of money for some people, I think. All right? Okay. So we had to, in order to do this, we had to make all kinds of assumptions. I mean, one assumption we clearly made was the debt equity ratio is constant. As you have seen, or as you have not seen me adjust the WACC method, the WACC itself over 5 years. We simply discount it with the constant WACC. And that really means we have assumed that it will remain unchanged. All right, we also have assumed a constant tax rate, right? It was always 28%. In the real world, as I've already mentioned before, it's perfectly conceivable that either of these or both of the assumptions are not met. Okay, there's one problem now. When we look at this, we end up with a conclusion, yes, we should do the project. Why would we? Because engaging in this project will add value to our company. How much? $5.728 million, assuming that, where is it? These forecasts are correct, that it really will yield pre-tax cash flows of 18 million and all the other assumptions. Sure. So let's say you are working for me, I'm your boss, you are my first lieutenant, and I say, hey, please can you figure out should we do the project or not, and then report back to me. And then you show up in my office and you say, hey Flo, yeah, I think we should, because this project will add value to our firm. It will increase our overall firm value by $5.728 million. And I would say, yeah, amazing work, happy to hear this, let's do the project, but one brief question first. Is the project itself so amazingly good that it yields such a high positive net present value? Or is the value that it adds the result of the way we finance it? Is this influenced strongly by our tax savings based on the fact that we use debt financing? So essentially in normal human language, I'm asking you, where exactly is the value added coming from? Is it the project itself? Or does it, like I say here on the slides, does it come from financing effects? And that is a problem. So basically you can tell me the project is okay, let's do it, but you're not really able then to explain to me why. And that is relevant. We don't simply want to make a correct decision. We also need to understand where the value is coming from. And that is something that the WACC method, sadly, unfortunately, cannot provide. So the better method for answering a more detailed question would be the APV method, adjusted present value method. I'm quite a big fan of it. It's also, you will see, it's easy. But what it does is, I find it conceptually very interesting. We basically say, we look at the project, we can look exactly at the same project, and we split it up. We're basically calculating two net present values. We calculate the the base case of the project. So we say, let's calculate the present value, the net present value of the project itself under the assumption by pretending that it's all equity financed. That is what we call the base case. And then secondly, we calculate a second net present value, only the net present value of all the financing side effects, where we can, in the real world, pack in all, well, financing side effects, such as, of course, the tax shield, costs of issuing any kind of financing, any kind of tax benefits, any kind of subsidies. So in the end, we then say, the net present value of a project will be this, some sort of adjusted present value. That will be positive or negative, whatever. But we present it as the result of two other net present values. We say the present value of the whole project is the present value of the base case, which is the project all equity financed, plus, why does this keep happening today? Plus the net present value of the financing. I don't know what's wrong with me today, guys, sorry. Too hyper, too much coffee. Plus the net present value of the financing side effects. And then you will still end up being able to come to my office. Hey Flo, good news. The project has a highly positive net present value. So yeah, I think we should do it. And I will say then, okay, but why? Is the project so amazing? Or does the value added, the positive net present value, come from the way we finance it? And then you can say, oh, glad you ask. And then you can really show where is it coming from, all right? So let me check the time quickly. What's the time? Yeah, sorry, long overdue break. Guys, let's go into our break. Let's have a 10-minute break and I'll show you the two remaining methods. If you were able to handle this, it's not gonna get any more difficult, all right? I have in total, in case you're wondering, 21 slides. So we are well past 50%. Nothing to worry. I will see you again in 10 minutes, okay? So guys, come back to me slowly. So, all right. Give me a second. Okay. All right. Okay, guys, let's look at the APV method. As I've said, what you should expect at this point, we are still again calculating a net present value. The only difference is actually we will break it down into two net present values. The net present value of the base case, so assuming the net present value assuming it were all equity financed, and only the net present value of the financing side effects. Why do we do it? So that we have a little bit of a better understanding what the quality of this project really is. So this
I have a quick question.
Sure.
Would that assume that only positive side effects would come from the finance side and not actually from in comparison to the actual project?
Yeah, exactly. Only the financing side effects, not the project itself, really only of the financing side effects. Absolutely correct, yeah. Okay, let's do it. So, brief disclaimer. I use this example because it's an example that our textbook uses. I find it's a bit difficult, but not because of the example itself. It's really not more complicated than I have described. What makes it complicated in my view is the way it is described what's going on. So if you perceive this as difficult, that is where the difficulty comes from. If you think, oh my God, what do I do if I get something like this on the exam? If you were to get an APV example on the exam, Celine and me would make 100% sure that it's crystal clear what is going on. The difficulty on the exam will not come from unclear language or vague descriptions. That I can promise, okay? So please don't freak out, is what I'm saying. And of course it's color-coded, you see, so that should work out all right. Let's have a look. So we are looking at a company that has a current, right now, debt to equity ratio of 50%. They are in a corporate tax bracket where they pay a corporate tax of 29.8%. We also know the required return on the firm's levered equity. It's 16%. From our perspective, of course, that is of course the cost of equity again. The company wants to expand its production. They need to purchase some new machinery for that. The new machinery is expected to generate the following unlevered cash flows. Unlevered cash flows here means EBIT multiplied with 1 minus the corporate tax rate. The cash flows are given in this form. So the initial investment will be minus $24 million. In year 1 we will earn 8 million, in year 2 we will earn 13 million, and in year 3 we will earn 10 million. If you were to do this as a normal net present value, it would be a matter of 2 minutes. But of course, we cannot simply now calculate everything together. We need to be a little bit more specific. So how are they financing all of this? Well, and this is especially the yellow part here. This is, I think, where the difficulty comes from. Again, it's not really the content, it's the way it is described. So the company has arranged a 12 million debt issue. So they are issuing a bond. They are trying to raise debt. How much? $12 million. Why? They want to partially finance the expansion in this way. Under this loan or this bond, the company, and this is where the description is a bit, I think, lacking. Under this loan, the company would pay an interest of 9% at the end of each year on the outstanding balance at the beginning of the year. I have a table, I hope it will become clear in a second. The company would also make year-end principal payments of 4 million per year, completely retiring the issue by the end of the 3rd year. So what does it mean in normal human language? So the company wants to finance the 24 million here partially with debt. Half of it will be financed with a bond issue or loan, 12 million. On the loan, they have to pay 9% interest expense. On not this fixed amount, but every year the company pays back of the amount they borrowed, so of the 12 million, 4 million, and the delta, what is still outstanding after each year having paid 4 million, on that they pay 9%. In the table it will become much clearer. And what we have to do is, yeah?
I heard stuff falling, sorry.
No? Sorry. Brief disturbance. We are supposed to use the adjusted present value method and answer the question, should the company engage in this project or not? Let's hop in. You're probably right in expecting that this year will keep us quite busy. What is the core logic of the whole method? Well, we say the adjusted present value of the whole project equals the net present value of the base case. The base case is the project under all equity financing, which we already know is not going to happen. But still, that's the core logic. Plus the net present value from whatever financing side effects we observe. Okay, step one. We calculate the unlevered cost of equity and we can fall back to Modigliani-Miller, proposition 2, with corporate taxes. This is of course the formula. There's nothing new, I think, here that should throw you off your game. And we have all kinds of information. Maybe brief information to make sure we're all on the same page. Why am I doing this? I mean, we know, look here, the required return on the firm's levered equity is 16%. So why do I need to deal with Modigliani-Miller here? The reason is we are trying, let me go back one more slide, we are trying to calculate the adjusted present value of the project. And we split it into two net present values, the base case and the net present value of the side effects. But the base case is all equity. So in order to deal with this, we of course need the unlevered cost of equity, right? Because if we pretend the base case is all equity, that is the correct cost of equity, unlevered, because all equity. So that is why I need to now utilize Modigliani-Miller here. And this is maybe a slightly different use of Modigliani-Miller than you've seen before, but again, it's the same formula. The only difference is now we actually do know the levered cost of equity. It's given 16%. We know the cost of debt, 9%. We know the debt to equity ratio, 50% was given. And we know the corporate tax rate, 29.8%. What we do not know is R0, also called RA, the unlevered cost of equity. So I need to utilize Modigliani-Miller proposition 2 with taxes to basically reverse engineer the unlevered cost of equity R0. And that's what I do. I simply rearrange and calculate and I find the unlevered cost of equity is 14.18%. Okay, and we're almost done with step 1, calculating the net present value of the base case. What is the net present value of the base case? Well, it's simply the present value of the unlevered cash flows. So that's what we do. Net present value equals minus 24 million. That's the startup costs of the project. Initial minus. Plus, let me go back one slide. I simply incorporate now the information about the future earnings, about the future cash flows that this expansion will help us to generate. 8 million, 13 million, 10 million. And I use the unlevered cost of equity for discounting, as you can see here. And I find the net present value of the base case. So if we were to do this in an all equity way, is minus 304,000 and a little bit more. So if our plan would have been to do this all equity financed, we already have a conclusion we should not do it because it's negative. But that is the all equity case. We still have to factor in that we might get to enjoy some, positive financing side effects from the debt financing we use. So that is the second step we need to do. This is the table where I thought it makes it clearer what these repayment terms on our loan actually mean. Yeah, we need to find the net present value of the side effects. I would suggest that you compare the whole table to the information in red I have here. Okay, then it makes a lot more sense. Just brief repetition. We borrow 12 million at 9%. What do? Well, at the end of each year, we have to pay 9% on the outstanding amount at the beginning of the year. And each year we repay 4 million of the original amount, 12 million, that we have borrowed. So this is how it plays out. So the debt level at the end of each period, that's easy to figure out. We borrow 12, and each year we repay of the amount borrowed, of the principal amount, 4 million. So 12 minus 4 is 8, minus 4 is 4, minus 4 is 0. So that's how I get the first row. And then I simply calculate the interest expense as what is the amount of debt at the beginning of the period multiplied with the cost of debt, the 9%. Boom, boom, boom. There we go. I track here also the principal repayment just because, basically for the sake of completeness, that I can see I have factored in all the information available. And separately now I calculate the tax shield. I simply calculated interest expense multiplied with the corporate tax rate. The interest expense we have available here, so I simply multiply this. Again, it's not complicated with paper pencil. If I can do this using Excel, yeah, on the exam I would show up with a high-powered Excel sheet that can take care of WACC method and certainly of adjusted present value method as well, so that I can do this very, very quickly. And as you see, we are now calculating the second net present value. We have done the base case, and this is not a net present value only of the financing side effects. Naja, in this case, there are not that many. We only have the tax shield to consider. In the real world, could be much more. There could be subsidies, whatever, that we could include here as well. Yeah, so I simply have here the tax shield from year 1, tax shield year 2, tax shield year 3. And I discount with the 9% because that is RD. Type in the numbers and you find the net present value of the financing side effects, only of the financing side effects, is 558,000 and a little bit more. What does this mean now? Should we do it or not? Well, we still need to calculate a total net present value now. So I have here, it's an alternative way of calculating. I don't want to go through it during class. I've mapped it out in great detail. You could do this in a in one big calculation as well. This is how it is, simply to show you an alternative. It's not a game changer. I want to show you how to combine everything. We are still talking about should we do this project or not, and calculate the adjusted present value as the net present value of the all equity base case plus the net present value of the financing side effects. So yeah, I screwed up here with the color coding. I don't know, it was super difficult to fix. I will try to adjust, so please don't be confused here. We have calculated the net present value of the all equity base case as negative actually, minus 304. And we have separately calculated the net present value only of the financing side effects, 558. So the total adjusted present value, the net present value of the project, would be plus 254,000. Should we do the project or not? Yes, we should. But now you come to my office and you say, hey Flo, yeah, good news. Highly positive net present value, $254,000. We should do it. And I will ask you then, is the project so good? And you will say, no, actually the project itself is not all that good, but based on the way we finance it, it is still a project worth pursuing. Where is then the positive value coming from? Really, we can see it now quite well from the financing side effects. Does this make sense, guys? Is it clear? Super. So I hope you believe me when I say the difficulty of this specific example does not come from the actual difficulty of the method. It's a bit tricky to figure out how the repayment terms of this loan or bond issue work. The rest is, there's nothing fancy here. Once you need to utilize Modigliani-Miller, rearrange slightly, but like I said, you can practice this to perfection. Okay, so what's super relevant about the adjusted present value method? Well, it allows us, it enables evaluation to be broken down into components, providing more information. So we see the impact of capital structure, the impact of the way we finance. It is considered to be a very attractive method, simply because it allows a deeper understanding what creates value. It is relevant to know that a project creates value, but we also want to understand why, where it's coming from. Also, you've seen this in the adjusted present value framework. Using this method, we do not need a stable amount of debt. That could theoretically change. But what we do need is we need to know the absolute amount of debt. Otherwise, we cannot calculate our tax shield, which is of course a prime suspect for financing side effects. Okay. Let's look at the last method, the so-called flow to equity method. I will show you in an abstract way how it's done. This is really it. Then we are done for the day. In case you're wondering why I'm not showing you an example here, because as you know, I'm not teaching in isolation and neither does Celine. We communicate very well, and that is something that where she has designed a beautiful workshop exercise to show you that in application. So I will walk you through it, how it works. You will see the fact that I have a cooking recipe for you means you do not need to worry. There are certain steps you have to go through and it works every single time. So it's called flow to equity or equity residual method. What is at the core of it? Well, we are trying to estimate cash flows to levered equity. So that means we are trying to figure out if you are a share, we are trying to figure out how much the magnitude of the cash flows that goes to the shareholders of a levered company. That's what this sentence here means. Okay, how are we gonna do this? Well, when we are valuing the after-tax cash flow to levered equity, so that considers that we're not looking at an all-equity firm, we discounted the required return on levered equity. We are assuming a relatively constant debt ratio, okay. What else is relevant? Yeah, this is a bit of a disclaimer for the real world. This is not normally used for individual projects. And the reason for that is you would need, if you're the analyst, you would need a lot of detailed information that typically you would not have. You need to know the cost of debt. If you are working for a company, you're trying for your part of the company to engage in a new project, you do the project valuation, you would, being a decentralized manager, probably not know in depth the actual cost of debt. So that could be a little bit more tricky to do in the real world. Yeah, when is this method used? So I know from experience, many of our master students in the finance master are crazy interested in mergers and acquisitions and takeovers, so all of this. If that is something that you find super interesting, then you wanna familiarize yourself with this method because, like I said, it's normally not used for projects. So for what is it used then? For really whole firm valuations. In which context? Mergers and acquisitions, or extremely large projects, but not when you are a decentralized manager, okay? So long story short, if you're crazy about mergers and acquisitions, you already know this, you want to know a little bit more, flow to equity method is not going to be a waste of your time. And how is it done? It is really a cooking recipe, and I only call something cooking recipe if there are very clear steps that you can always follow through and it always works. This is one of them. Okay, which steps do we have to go through? So we have to, in a first step, figure out the annual after-tax cash flows to levered equity. Complicated, sounds complicated, but really isn't. The levered cash flow is calculated as EBIT minus I. Let's talk about this term here. EBIT is of course short for earnings before interests and taxes. So what do I get if I say EBIT minus I, so interest expenses? Well, I get the EBT. So I have then deducted all my expenses, even the interest expense, and I end up with earnings before tax, also known as profit before tax. And if I then multiply my earnings before taxes with 1 minus TC, I obviously get an after-tax cash flow, right? Okay, we need to figure out our cost of levered equity. How can we do this? Again, Modigliani-Miller proposition 2. The same formula that you have seen many times already in the last method, in the adjusted present value, we use the same method. So I fill in all our values, not this time we are not solving for R0, we are really solving for levered cost of equity. And in the last step we say, okay, what is then the value of the levered equity? The levered cash flows divided by the levered cost of equity. And last but not least, what is then the value of the firm? Brief sidebar here. Why do we say now value of the firm? Don't forget what I just said before. This method is typically used not for deciding if we should do an individual specific project or not. This is typically used really to figure out the value of the whole firm. So we then say, what is the value of the whole firm? The value of the firm's debt plus the value of the levered equity. That's what it really is. Okay? Okay. What is relevant, guys? What is relevant about today's lecture? I want that you understand when we talk about, rather casually, about net present value calculations, and we simply say minus cash flow at T0 plus cash flow at T1 divided by blah, 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 that this is a bit, I don't want to say inaccurate, but it's not, immediately something we can execute. We need to be more careful, we need to be more specific. Which cash flows are we talking about? Before tax, after tax? Where do we include side effects? So the three methods are all doing the same thing. They look at the future cash flows. They are more accurate about them. Which cash flows are we talking about specifically? And we discount them back to T0. So the three methods I showed you, at least briefly, all belong to a family of valuation methods called DCF, discounted cash flow methods. And the only difference between the methods is which cash flows do you use and what exactly do you use for discounting. Okay? Like I said, they are all, the whole chapter you can study in a standalone kind of way. So completely theoretically possible, out of context, they will work. And I expect my students on an exam to be able to ace this. There's nothing to, no excuses, no nothing. Practice this chapter to perfection. Maybe a last thing about the actual content. Please go to the workshop. So Celine and me really carefully designed the exercises. I don't know from the top of my head. I think it's on the agenda in next week's workshop. We're a bit ahead of the game. So please go there. It's definitely gonna add value. And maybe you need a bit of motivation at this point. So I thought I wanna say a couple of things. What's still missing actually in our course. So we are doing, I think, very well in terms of time. And as far as I can tell from the messages you send me, I think it's going rather well. I'm certainly not worried. I'm very happy with how things are going. I would like to tell you a little bit what is still gonna happen in terms of new content. So this is done. I have one very big chapter still for you and two small chapters. Let's maybe talk about the two small chapters first. I don't want to say small because irrelevant. They are not irrelevant. The two chapters are working capital and efficient markets. Efficient markets you have done a ton in the first year as well. So I usually do one lecture, both of these topics together. In the context of working capital, I want to show you the operating cycle and the cash conversion cycle because I think it's a beautiful, intuitive concept. It's actually more accounting really than finance. I love talking about it. We can have very specific firm examples. It's not complicated. You can study it to perfection. Nothing to worry about. And in the context of efficient markets, I like to zoom in on certain behavioral issues. So I know you have done this. I will not bother you with boring details. I want to zoom in on a couple of topics that I myself find very interesting, where we can chat a little bit about it. Already a little bit keeping in the back of my head that many of you will do some sort of master. And that is a topic where there are plenty of sort of master thesis topics built in. And if you say, well, master thesis, who cares? I aim higher. Nobel Prizes in economics are awarded for work in this area as well. So that are the two sort of smaller chapters, or at least the way we address them will be a little bit smaller. It will be one lecture both together. So what's the big topic that's still missing? Options. Options will keep us busy for at least 2 lectures because I really want to take my sweet time and make sure that you're all perfectly on board. Our lecture on Wednesday will be, I will show you how options work. There will be no math whatsoever. It will just be payoff diagrams. and we look at basic option payoffs, and I will show you how to combine them to modify very different payoff profiles. You will see you will not struggle with it at all. It's perfectly possible to explain it in a clear way. But we are not happy to understand simply what we can do with options. What is the difficult part of options? It's option valuation. So options are financial instruments in some way like a bond or like a share, in the way that you can buy and sell them. But they are very different from shares and bonds. So they are much more difficult to price. So don't want to scare you, but I want to be honest with you. Options are very, very old instruments. So they really go back several hundred years. But for several hundred years, we did not know what the fair price of such an instrument should be. That was only discovered or invented maybe by Mr. Black and Mr. Scholes. So, and they received a Nobel Prize for that. So yes, putting a price tag on an option involves math, and the fact that the two guys who came up with the formula, like Scholes, received a Nobel Prize is already a little bit hinting at it's not exactly kindergarten math. But there is no need to freak out majorly. You do not need to derive the formula, and I don't mind admitting I do not think I could derive it myself. I mean, really, from zero to the final formula, that's really brutal. To use the formula is very straightforward. It's a formula that looks scary, really scary. But in order to use the formula, you need every single ingredient. So it's basically just some formula where you need to crunch the numbers. But in order to get to Black-Scholes, I need to build you up a little bit. We need to first go through two other methods, simply that we can comprehend what makes the formula of Mr. Black and Mr. Scholes so amazing. And that is a little bit challenging. It can be explained in a clear way, and we have absolutely the time to do it as diligent and slowly and in-depth as you like. That is it. So I think we have 3 chapters left. 2 small, interesting, not scary at all. That's really a bit of a reading chapter, a bit of chatting about it, nothing to worry about. And we have options, a little bit more challenging, especially option valuation. But I promise I will do my utmost to help you understand it. And in the past, usually students they even wrote in my evaluation, it's so, a couple of years ago, it's so unfair. On the exam, we got many difficult exercises about discounting, but nothing easy like options. And the head of it was phrased as a complaint, and my department head then said to me, that is really a good job if you make students think that option valuation is easy and they complain about this. So yeah, please don't worry too much. We're almost there, okay? You just need to hang in there. And obviously you come to class. If you meet other students that you know don't come to class, please encourage them, please invite them to come, because options is a brand new chapter. It's a new page. It has nothing to do with Modigliani-Miller. It's a completely different ball game. And also our conversations about working capital and efficient markets, new chapters. So everybody who might not be participating in the course yet, they can easily on Wednesday join as if it's a first lecture, okay? Guys, are there any questions, anything I need to know about, anything that is worrying you, anything I might be able to help with?
I had a question.
Shoot.
At the beginning you touched a little bit upon inflation, but I was wondering, how does inflation or deflation impact either the FTE or the APV or the WACC?
Mm-hmm. So, if you look at the description here, so I would use the APV method for that. I would incorporate inflation rates in the actual cash flows. So that are here clearly nominal cash flows, nominal as in the actual magnitude 8 million, 24 million, 13 million and so on. You could say, well, I expect an inflation rate of whatever X%, and you calculate here then with real cash flows, so that you adjust them by the inflation rate already. So meaning you basically adjust them down to reflect the loss in purchasing power. It's as easy as that.
Okay, perfect.
But also, I mean, let's not forget, I just want to say this because I'm not happy simply teaching you a method and pretending it's all awesome. Don't forget, I mean, right now we are in a very, in an environment with very low interest rates. There are, of course, discussions. If the interest rates are so low, then the consequence is people borrow money like crazy and buy stuff like crazy. What happens if people have so much access to cheap money and spend it like crazy? They drive up prices. And if you say, yeah, of course he says that because it's the abstract ivory tower of science, in the real world that does not happen. I mean, it happens in the real world. If you live in Rotterdam and you're looking for a student house right now, you know exactly of what I speak. We have low interest rates. You can borrow money almost at 0%. Everybody buys houses like crazy, so the demand for houses has gone through the roof. And as a consequence, the real estate prices are completely through the roof as well. So that's really happening. Okay, guys, excellent work. I've said it before, I want to say again, I really admire that despite the difficult circumstances of online education and well, Corona, of course, that you're coming to class and talking with me about this abstract stuff. I think this is very admirable. Hang in there. I can honestly say the worst of the whole course is behind you. Now we have to wrap it up and basically land the plane, okay? Guys, hang in there, keep up your motivation, and especially if there's something going wrong and you suspect I might be able to help with it, then let me know, okay? And beside that, today is amazing weather. Sun is out. Get some sun. Guys, have a great day, and I'll see you on Wednesday morning, I think 9 o'clock, in usual awesomeness for some serious option conversations. See you guys.
Bye-bye.
Bye.
See you. Doei doei.